Hello, hello, hello. So our federal government just announced a series of significant changes to mortgage rules that they say will help improve housing affordability and help Canadians get into home ownership. It's about time. But will these changes actually work? Or is it all just smoke and mirrors meant to generate positive headlines? Those tricky politicians, you can never really know, can ya? In any case, we're gonna tell you all about the changes. We're gonna give you the glass half full and the glass half empty cases for them, and then we'll let you make up your own mind. And oh yeah, we're also gonna talk about whether all of this renewed positive sentiment made an actual difference in Ottawa's real estate market last month. So get ready for all this and more in your October 2024 Ottawa real estate market update. Let's go. All right. As always, we're gonna kick off the update by telling you all about what happened with freehold sales in Ottawa last month. That would be September, month that comes before October. After that, we'll talk about condos, and then in the second half of the video, we'll tell you all about these upcoming changes to mortgage rules that are going to save housing. Maybe, probably not, but we'll tell you all about them anyway. So now, without further ado, let's get those September 2024 Ottawa freehold sales stats up on the screen. And hey, Andrew, let's do like a beautiful mind kind of montage-y thing when we put these up, all right? 1, 2, 3. All right, that's probably gonna look really dumb. But anyway, we sold 939 freehold homes in Ottawa in the month of September. Now, for anyone who is unsure of the difference between freehold and condo, it's simply that with freehold, there are no condo fees. All right, I'll get that out of the way. So 939 sales in September was a good little drop from the previous month. That would be August, the month that comes before September, where we sold 999 homes. All right, that being said, this year's September total is nonetheless a fair bit higher than the September totals for 2023 and 2022, where we sold just 856 and then 806 freehold homes respectively. Now, in the second half of 2022, which is the half that September falls into, and throughout all of 2023, the sentiment around the real estate market here was caca, all right? I would have preferred to use a different word there, but YouTube gets upset when I do, so we're gonna keep this PG. Just so you know, that word was. But yeah, so we had a lot of negative sentiment during that period, which led to very low sales volume, okay? In a typical year before the pandemic peak, we would have expected to see between right around 1,000 and a little over 1,100 freehold sales occur in Ottawa. So this September really just continued a trend that we've been seeing for a few months now in freehold, which is that volume is consistently coming in pretty close to the lower end of the range we'd seen for that particular month over the course of the few years that preceded COVID. All right. So it's not caca volume, but if you want to think of the years just before COVID as normal years, then we're also not quite back to normal yet either. And now I've said this multiple times before, but I think this may just become the new normal. We're still dealing with a relatively small sample size though, so we'll have to just kind of wait and see there. Moving on, the average sale price of a freehold home in September was $733,408. And that, ladies and gentlemen, is a new September record. All right. So good job, listing agents in Ottawa. Buyer agents, you need to negotiate better, all right? I'm kidding, all right? Before you get all pissed off at me or your agent, it was a joke. Everybody's doing the best they can, and we agents don't make the market, we just work within it, all right? But if you do want a good agent for buying, selling, or investing, call this guy. All right, yeah, so not screwing around, 733K and change was the highest September average we've ever seen in Ottawa. Now, funny enough, the second highest average was in 2023, where we hit about $723,000. And that was a caca year, remember? Right? And the difference between 723,000 and 733,000 is really closer to a rounding error than it is a significant gap. All right? So I find it very ironic, don't you think, that we all think and talk of 2023 as having been this terrible year in real estate. And then when it comes to 2024 so far, we think of it as having been so much better, right? The tone for 2024 is always much more positive. The market's coming back, buyer confidence is back, et cetera, et cetera, et cetera. But when you take the stats for the 2 years and you look at them side by side, I think it would surprise many to see that the difference between 2023 and 2024 so far actually not that big. Like, yes, sales volume and average sale price are definitely a little better this year, but if I just showed you the stats for both years without any additional context, I don't think there's really anything that would jump off the page. Anyway, it's something I just find really interesting, and I think it's a good example of how sometimes things that feel very real or that feel like they're just common sense may not be quite as true as we thought, right? And that's why we like data, right? At least I do. Right? Now, speaking of data, hey, look at that segue. Let's talk about inventory. Right? Quick reminder, as always, inventory is a measure of both supply and demand all in one. And in September, we saw an increase of freehold inventory in Ottawa. We went from 3.3 months of total inventory at the start of the month, and we ended September with 3.8 months of freehold inventory. That marks the 5th straight month where inventory has climbed. So that means there's more supply entering the market than demand, right, over the course of those 5 months. However, in a big picture sense, our current inventory levels are still just straddling the line between what we'd expect to see in a balanced market and like a weak seller's market. So it's not super high by any means. It's actually pretty healthy. In September, we also saw our sales to new listings ratio come in at 43%. And the properties that sold in the month on average took 35 days to do so. Okay, so we've got a sales to new listing ratio that falls into balanced market territory, which is anything between 40 and 60%. We've got an average time to sell, which falls into balanced market territory, which is anything between 30 and 60 days. And finally, we've got an inventory level, which essentially also falls into balanced market territory, which I'd say is anything between 4 and 5 months rounded. All right? So as you may have guessed, I'd say we're in a fairly balanced market right now in Ottawa. In a balanced market, we expect stability, right? Generally speaking, in this type of market, we aren't seeing major shifts in prices, right? And so what that means is that if you're a seller with an overpriced listing and you're just waiting for the market to catch up to your price, you might be waiting a while. Right? And then the same thing applies to any buyer who's out there waiting for prices to come down before making an offer. Don't hold your breath, right? Unless you can hold it for months or maybe even years, like some weird real estate dolphin, right? What are we even doing this month? All right, so that'll do it for Freehold. Weird real estate dolphins and all. Now let's quickly run through the condo stats before we talk about these new mortgage rules, shall we? But, of course, before we get to the condo stats, I'd like to take a moment to thank this month's Market Update sponsor. This month's Market Update is brought to you by the Public Service Alliance of Canada, or PSAC. We'd like to thank PSAC for, sorry, hold on, I'm getting, what? Okay, wait, sorry about this, everyone. I'm actually being told that, this is awkward. Okay, I've just been told that PSAC found out that Serge Papineau Real Estate is also a small business, and they've unfortunately withdrawn their support. Really? Oh, gee, okay. They're boycotting me now. I guess I'm being boycotted. Okay, well, I'm just trying to help people buy and sell real estate here. All right, well. Guess we don't have a sponsor this month, so let's just move on to condos. We'll get those stats up on the screen for you in 1, 2, 3. All right, a little overzealous. All right, so the condo market in Ottawa is also balanced right now, though I'd say it is a little softer than the freehold market. We sold a total of 264 condos here in the month of September, which puts us in the same range as 2023 and 2022, where we sold 250 and 264 units respectively. So unlike freehold, condo volume hasn't broken above the levels seen during the two caca years, right? And I promise this is the last time I will use the word caca in this update. The average sale price for condos in September was about $428,000. That's almost a 4% increase from August, where we were right around 412,000. The average selling price for condos here does tend to bounce around from month to month, but for the better part of 2.5 years now, it's landed somewhere between 410K and 453K every single month except one. That was May of this year, where we were just above that threshold. In August, we saw the average price come in very close to the bottom of that range. I wondered in last month's update if we'd be seeing the start of a trend, especially given all the negative news recently about the condo market in Toronto, aka the center of the universe. But for now, at least, it appears that low August average may have just been a blip or random variance, as we found ourselves right back around the midpoint of our familiar range in September. Okay, now, just a quick aside, in our August update, I went into detail on how the condo market in Ottawa differs from Toronto's and why I didn't think we were nearly as susceptible here to the issues they're having over there. So if you'd like to know more, I'd highly encourage you to check that one out. Having said that, even though I think our fundamentals here are stronger, I am still curious to see whether Ottawa's condo market will suffer any kind of carryover effect from all the negative headlines that are likely to keep coming out of Toronto over the next few months. So stay tuned for that. We'll keep you posted as always. All right, finishing up on condos here. In September, we saw inventory levels rise from 3.3 months to 3.8 months. That's the highest inventory level we've seen all year for condos, but it's still a figure that, historically speaking, is on the healthy, slash lower side of things. Our sales to new listings ratio in September for condos was about 48%, and condos on average took 41 days to sell. So as mentioned at the top of this section, rounded inventory levels, sales to new listings ratio, and average time to sell all put our condo market in balanced territory, okay? The overall stats and trends for condos and freehold they're not much different right now, though I tell you that the sentiment around freehold feels more positive than for condos, right? I suggest that part of the reason for that is that we're starting to see investors dip their little tippy toes back into the market here, and they are all, for the most part, only looking at freehold properties right now. So it'll be interesting to see if the condo and freehold markets here continue to more or less trend in the same general direction, or if we start to see maybe a little more significant divergence between the two in the months to come. And once again, we will keep you posted, so keep it locked once a month on this channel. All right, and that, your friends, will do it for the stats. All right, hope you have fun. Now let's talk about these new mortgage rules that are allegedly going to make it easier for Canadians to get into home ownership, shall we? So September saw the announcement of 3 major changes to mortgage rules in Canada. One of those changes came from the OSFI, which stands for, it's OSFI by the way, which stands for the Office of the Superintendent of Financial Institutions. They're an independent agency that regulates our financial institutions in Canada. And it also kind of sounds like they came up with their name using ChatGPT, but I digress. The other 2 big changes came directly from Canada's Department of Finance, which is headed by Liberal Minister Chrystia Freeland. You may have heard of her. She's been in the news a lot lately. And as is usually the case, the reaction to these changes has been somewhat mixed, especially for the 2 that were brought forward by the Liberal Party. Okay? And so what we're going to do here is we're going to tell you all about the changes, and then we'll give you some positive and negative reactions for each. So basically, we'll give you some glass half full and some glass half empty views on each. Okay, cool. All right, so let's start with the change that was announced by the Office of the Superintendent of Financial Institutions. A few days ago, the OSFI announced that homeowners will no longer have to requalify under the stress test when switching lenders upon renewing their mortgage. Okay? So what that means, real quick, when you first get a new mortgage in Canada, you have to qualify under what's known as the stress test. All right, and you've probably heard about it, but in a nutshell, and I am oversimplifying a bit here, what it means is that in order to be approved for your mortgage, you essentially have to be able to qualify for the same amount of loan at an interest rate that is 2% higher than the one you were actually getting. Right? So like, for example, if you wanted to get a $500,000 mortgage that came with a 5% interest rate, you'd have to be able to qualify for a $500,000 mortgage with a 7% interest rate. Right? Simple enough, right? Okay. So the catch was that once you had that mortgage, every time that mortgage was up for renewal, right? So every 3, 4, 5 years, the only way to avoid having to re-qualify under the stress test was to stay with your current lender. So obviously, the old policy made it a lot harder for borrowers to shop around come renewal time. And it also gave them a lot less leverage when negotiating with their current lender, right? In other words, it caused a lot of borrowers to just kind of feel trapped, right? Especially in an environment where rates have increased. So the stress test is a little harder to pass, but not no more, all right? Not no more. Now people, I was such an idiot this month. Now people who already have a mortgage will no longer need to be re-stressed or re-stress tested when changing lenders, all right? So you're now going to have a lot more leverage as a borrower, and that will hopefully push lenders to, sharpen their pencils and compete a little bit more for your business, all right? So I think this one's all positive. I said I'd give you the positive and negative. To me, this is just all positive. I can't really think of any downside to this change unless you're like a bank, I guess. So yeah. This one isn't really like a glass half full as far as I'm concerned. It's just it's a full glass of OSFI goodness, all right? Does a body good. So that's change number one. Now let's move on to the two more controversial changes, shall we? And we're gonna have some opinions on those, I promise. As I mentioned at the top, on September 16th, the Liberals announced two major changes to Canadian mortgage rules, of which Finance Minister Chrystia Freeland said the following, and I quote, direct quote, "It is going to put the dream of home ownership in reach for more young Canadians, while also encouraging those same young Canadians, come election time, to overlook the fact that the complete mess that is Canadian housing is a direct result of many years of reckless and short-sighted Liberal policy." You have to appreciate the honesty from Minister Freeland here. Okay, so I may have made the last part of that quote up, maybe. In my defense, I feel like it was kind of implied, but yeah, the first part was actually real. The first line was real. And so put the dream of home ownership back in the hands of young Canadians, or whatever she said. All right, so on to the changes, okay? And we're gonna start with the positives here. Okay, so the first change is that come December 15th, all first-time buyers will have the option of choosing a 30-year mortgage on the purchase of any home, whether it's new or resale. And those same 30-year mortgages will also be made available across the board for brand new homes. That's whether you're a first-time buyer, a 10th-time buyer, an investor, etc. So first-time buyers and anybody buying new construction can now opt for a 30-year mortgage, whereas in the past, the longest mortgage they could have gotten in most cases would have been 25 years. The obvious benefit of this change is that taking a 25-year mortgage and stretching it out over 30 years is going to lower your monthly payment. And for those wondering by how much, well, with current interest rates, you end up with a payment that's about 9%-ish lower every single month when you have a 30-year mortgage instead of a 25-year mortgage. To give you a practical example, if you had a $500,000 mortgage with a 4.5% interest rate, your monthly payment would be about $250 lower with the 30-year mortgage compared to the 25-year, right? And hey, that's not nothing, right? Like that helps for a lot of people. An extra $250 a month can go a long way. So that's the first change in a nutshell. The second change affects insured mortgages. You'll often hear insured mortgages referred to as CMHC mortgages. Not a totally accurate term, but I think you get the point. Insured mortgages allow anyone who is purchasing a primary residence to put a much smaller down payment on that purchase compared to the amount that would be required with a traditional uninsured mortgages. Uninsured mortgage, duh. And again, that's for anyone who's purchasing a home they intend to live in, primary residence, whether they're a first-time buyer or not. Right now, in order to qualify for an insured mortgage, your purchase price has to be below $1 million. As of December 15th, however, purchases up to $1.5 million will become eligible for insured mortgages. Now, to give you some additional context, traditional uninsured mortgages require a minimum down payment of 20% of your purchase price, right? For insured mortgages, however, you only need 5% of the first $500K and then 10% of the rest. So right now, before this change comes into effect, if you want to buy a $1.5 million home, call me, 613-868-6652. But yeah, if you want to buy a $1.5 million house, you'd need a minimum down payment of $300,000. Right? Might take you a while to save up that kind of change. Come December 15th, however, you could get an insured mortgage and only be required to put down $125,000 to buy that same $1.5 million house. Still a decent chunk of change, but nowhere close to what you'd need right now. I think this change is primarily meant to help people who live in expensive cities like Toronto and Vancouver. Remember, we're doing the positives here. So I think this change is primarily meant to help people who live in expensive cities like Toronto and Vancouver, where the average price of a home is already above $1 million and where even 1.5 million, to be honest, doesn't get you all that much in some areas, right? In cities like those, of course, rents also tend to be very expensive, which can make it harder for someone to save up a down payment, right? Even though they might be able to afford their monthly payments on that house. So this is ultimately going to allow some of those folks to get into a home sooner than they otherwise would have. It's going to allow some people to tie up less of their savings into their home's upfront costs, right? Which means they'll have more money left over for repairs, renos, emergency funds, etc. Life, you know? And it may also allow some folks to just kind of skip the whole starter home step and jump right into a place where they see themselves long term. It means they don't have to move again in a few years or deal with realtors or any of that stuff. Right? Now, another very important factor to consider with both of these changes, the 30-year amortization and the $1.5 million uninsured mortgages, and we are still on the positives right now. We're getting into a little bit of a gray area, but another very important factor here is that if we are ever going to fix our massive housing shortage in this country, we need to start building a lot more homes than we currently do. Not rocket science. That being said, demand for new construction homes right now is very weak, right? And that is in large part because they're just too damn expensive, right? They cost too much to make, they cost too much to buy. So the theory here is that if you allow longer amortizations across the board for new construction, you make the numbers on those homes work better for both end users and investors, right? And then if you also give those same end users the option of buying with much lower down payments, you're probably going to push a lot of them to opt for the more expensive brand new home over the older, less expensive resale home, right? And so they certainly wouldn't come out and say this, but I think the hope here is that these policies will help revive demand for new construction, and that increased demand could ultimately lead to an increase in the rate of production of desperately needed new housing supply. But, and here's where we go to the dark side on this, are we going about this the right way? So let's dive in. So there are a ton of factors that have led to Canada's current housing crisis. And for the record, I do not pretend to be an expert here by any means. I'm not an economist, I'm not a politician, thank God. But I think it's fair to say that our monetary policy during COVID played a pretty major role in the situation we find ourselves in. And what did we do during that period? In short, we gave everyone a means to take on significantly more debt than ever before, right? We pumped a bunch of money into the system, we gave out cheap loans, told you might not even have to repay them, and then we brought interest rates all the way down to record levels. And as we've seen, when you use debt to artificially inflate everyone's purchasing power, it usually doesn't actually make life more affordable in the long run. Quite the opposite, it leads to inflation, which just ends up making everything more expensive. So, I ask you, aren't we kind of just doing the same thing here with these two new mortgage policies? My opinion here, our housing policy should be focused on finding ways to significantly reduce the bloated time and the bloated costs required to develop new housing in Canada. That is how you accelerate new supply and bring about real housing affordability. But instead of doing that, we are once again being given artificial affordability in the form of more debt. Here's more debt. Enjoy. And make no mistake, these new mortgage policies are 100% inflationary policies. There's no ifs, ands, or buts about it. And even though they're being touted as a means of, you know, to put the dream of home ownership in reach for many young Canadians, these policies to me are really more for developers than they are for young Canadians. And don't get me wrong here, we desperately need those developers, right? Like, they're the good guys in this, right? And I know that the Reddit crowd's gonna get real upset about me saying that, but you cannot solve a housing shortage without development. And well, development is kind of what developers are all about, right? It's sort of their thing, right? So we need them. We need them. But ultimately, if you're not going to do anything to actually reduce the true cost of housing or the time it takes to produce it, then what happens? What happens when prices once again get to a place where they're just way out of reach for everybody? Is that when we introduce 35-year mortgages, 40-year mortgages? Do we start letting people buy $2 million homes, $3 million homes, $5 million homes with tiny down payments or no down payments at all? I mean, you can't just keep raising the debt ceiling indefinitely, right? That's just not a viable long-term solution. Eventually, the whole system just collapses, right? So yeah, I guess I'd say those are the negatives with these new policies. All right. That got real depressing, and I do have a bunch more stuff on this topic, but honestly, I just feel sad now. So let's try to wrap it up on a slightly more positive note, shall we? In spite of all the doom and gloom I just shoveled your way, I do think that having more choice is ultimately always a good thing for the people who make good choices, right? That's a catch. And so we can look at these new policies as just that, right? They're providing buyers with more choice than before. And for some people, in some situations, having a longer amortization or a bigger mortgage with a smaller down payment is in fact going to wind up being the best choice for them short and long term. So I guess that's the silver lining here if you want one. And hey, if you're having a hard time making a choice about your own real estate situation, I'm always happy to chat and give you my honest opinion. So, you know, no BS. Please feel free to reach out to me directly anytime, and you can do that using the contact information right here. All right, I think we managed to end it on a more positive note. So with that, I'm gonna say thank you as always for watching right to the end. I'm Serge Papineau, wishing you a happy Thanksgiving and a happy Halloween. Don't be the house that gives out raisins. We'll see you next month.